Hello and welcome to Bondcast, a podcast series where we discuss the latest themes and events shaping rates markets. I'm Imogen Bachra, European rate strategist, and I'm joined today by our global market specialists, Giles Gale, Theo Chapsalis, and Brian Daingerfield. Before getting into the discussion today, I just wanted to quickly remind you to hit the subscribe button so you can listen to our latest episodes as soon as they become available. And another reminder from me that if you have any questions that you would like me to ask any of our market specialists, then please send them in to bondcast@natwest.com. All right, guys, let's get into this week's episode. I'm very excited when I started speaking just then because I realized it's the first episode in, I don't know, probably the last 4 weeks where it's not going to focus solely on central bank speak and what we've had, and we can talk about all the other exciting things that have been going on while we've been distracted by central bankers. So I'm going to start with you, Giles, because I think one kind of big theme that perhaps is coming up, well, certainly coming up in the UK because of the rise in case rates, but perhaps as markets are focusing on it a little bit more because there's not much else going on. But we're seeing, a kind of surge in cases in the UK and of COVID at the moment. And I think, in Europe, we're starting to worry whether we're just kind of looking into the future and Europe is really just 2 weeks behind what we're seeing in the UK. So do you think that is the case, or are you confident that this is kind of a UK only thing, and also that the vaccine is really helping break that link between cases and hospitalizations and deaths?
Yeah, well, it seems like it's either central banks or it's COVID, doesn't it? So, and I guess that now, we're getting into the summer, then, people are naturally watching this very carefully, not just because they're worried about markets, but also they're worried about things like their summer holidays. It does seem like the bar's pretty high for actually pushing back on the sort of 19th of July sort of full reopening in the UK. But the case rates, as you say, have been increasing very, very quickly. So we did look pretty carefully this week at to what extent the link between cases, infections and hospitalizations, and ultimately, of course, mortality has been broken. And I think overall, we were very, very encouraged by what we saw. We have quite a lot of regional data, and so we can drill into okay, so what are the dynamics in the sort of the areas where the problem emerged earliest, in particular the Northwest. And you can see that compared to the last time we saw case rates of a similar magnitude, and of course, considering the normal sorts of lags that you would expect between infections and then people actually actually having to go to hospital. Now, it looks like we are down to perhaps hospitalization rate of maybe a tenth of where we were before. And not only that, but fortunately, the number of people ultimately dying in from the proportion of people who are going to hospital who then die is significantly lower as well. And so, of course, I dare say that a longer, more careful look at this might come up with something somewhat different, but very, very broadly, just to give you an idea, it seems like we were talking about something like 1/3 of hospital of cases that were serious enough to result in a hospitalization, ultimately resulting in a death about 4 months ago. Okay, that now seems to be something like 1 in 20, and so that doesn't mean, of course, that anybody should be complacent about any of this, but it does seem that vaccinations have really, really made a significant difference. Okay, and so does that mean that we're more optimistic? Yeah, of course it does. And in the European context, I'll just say, having just looked at the monitor that we publish weekly, They're really, the caseload in Europe, in continental Europe, has diminished to next to nothing. Okay, so although inevitably it seems like the Delta variant will take over and probably emerge as much more of a problem over the coming weeks, it seems like continental Europe has some time to play with here. So I don't think that this is going to develop as a serious problem, most likely in less than sort of 4 or 5 weeks. And of course, we know that Europe is behind the UK in its vaccination program, but it's not that far behind. It's probably something like a month, realistically. And so I think, for exactly the same reasons that we're more optimistic about the way that this is going to develop in the UK, I think we should be relatively optimistic about the euro area as well. Now, none of that's to say that, reopening and sort of international travel is not going to be a problem. I think that is something which, for today looks pretty uncertain still, I'd say.
All right, I'll hold off on booking my summer holiday still. I think that last point you make though about vaccines in Europe is quite important, because everyone made a big song and dance about how slow the Europeans were to start their vaccination program, but actually I'm not sure everyone has picked up on the fact that it's actually picked up really, really quite quickly in the kind of Q2 and continued. And Europe is now vaccinating at a faster pace than the UK is. And part of that is because the UK has slowed down its efforts, but it won't take long, like you say, for Europe to catch up. So the other thing I wanted to ask you then, Giles, because we touched on this last week in the podcast about how, we expected that the next few weeks could be quite quiet, but actually August, we could see a pickup in vol again. Typically August isn't as quiet as people think. And also we have a huge amount of risk events, which I think we kind of listed off last week, starting at the end of August and then heading into September. But if we're right that July, kind of COVID concerns aside, is going to be quite quiet, how should we be thinking about market moves, or how should we be best positioned for that, a quiet July? Is there any kind of trades that stand out to you?
Well, yeah, I mean, listen, it really does look like July is likely to be a little bit dull. I mean, the seasonals all, weak signals though they are, they all point in that direction. From our client conversations and the feedback that we get from everyone else in the bank that have client relationships, the overwhelming sense is that there's just not a lot of conviction, and positioning overall is relatively light as well. And so that just supports this idea that we're probably not looking for fireworks in July, although that, obviously anything can happen in markets. I think, just to answer your question about what we should be doing, for me this is just a continuation of themes that we've been on for quite a while. So I think curve steepeners, I think country spreads tend to do quite well. One of the ones that we flagged last week was France, which has underperformed over the course of the year, tends to do quite well in July. It's seen as a bit of a safe carry trade. If anything, the positioning is probably against France, not with it. And we just had, we've got some supply this week. and we just had the regional elections. It seems like everything is pointing in the right direction there. So it's not a particularly exciting trade, but I think it's a good one. But I think maybe not for today, because I've spoken quite a lot. But maybe for next week we should be really focusing on the run-in from September to the end of the year, where we've got real back-to-back of risk events. And I definitely think that will be that's going to make August potentially interesting. And I think if we're talking about re-engaging with some of our longer term themes, in particular the bearish Bund view, that's really what that's going to be about.
Like that. hooking listeners to come back for next week. All right, I'll take you up on that topic next week then, because I think you're right, that's definitely going to be, or there's definitely going to be a lot to focus on come September. So moving over to the US then, because we've talked a lot in the last few weeks about central bank policy, but one thing we haven't discussed so much is fiscal policy. And we had a bit of a breakthrough since we recorded the podcast last week that looks like a bipartisan deal might be possible. So Brian, could you just, I guess, before we get into any kind of more in-depth questions, can you just give us an overview of the state of play and where we're at in terms of that deal at the moment in the US?
Absolutely, and thank you very much for having me on the podcast. So last week there was a breakthrough in bipartisan negotiations. There had been on and off discussions between the president and Republicans. We had optimistic commentary. We had a breakdown at one point, but we've now had a breakthrough. So where are we? The number you will see in the media is this is an over $1 trillion deal. But what's probably more realistic is that this is amounting to $579 billion in new spending over 5 years. This bipartisan proposal. Now, this is a proposal not yet written into a law. And so one of the important things to take away from this proposal is that the pay-fors are not fully decided yet. And so, there was a proposal for, say, indexing the gas tax to inflation, so raising the gas tax. That was something that was in the original plan that the president asked to be removed. That apparently is going to get replaced. And so, as this goes from proposal into written law, there's possibilities for some things in the package to come in that were not in the original proposal. But I think if you step back and sort of close your eyes and think about what this deal is, it is a physical infrastructure focused plan that's significantly smaller than the president had hoped, $579 billion in new spending, as opposed to the $2.3 trillion he initially came out with. And it has no new tax increases and no change in what we call human infrastructure, social infrastructure. If you close your eyes and take a step back, that's really sounds like it's the Republican plan. It sounds more like a plan that former President Trump would be endorsing rather than President Biden. And so Biden really negotiated, I would say, in the direction of Republicans in order to get this deal to this point. And I think the fact that he was willing to agree to this proposal is really indicative that Democrats have more coming down the line. And this could really create some complications. The fact that we're on sort of two tracks right now. There's a bipartisan deal that we had a deal struck on, and then there's also the possibility of a partisan package. And that's something that really makes this deal quite fragile, because both sides of this deal are actually quite, both sides, I would say, are almost angry at the result. And so, bipartisanship is working when both sides are not particularly happy. So we'll see where it goes from there, but there are still complications for the deal.
What kind of a timeline would we be looking at here? I guess, first of all, for the bipartisan deal, and then perhaps for any kind of reconciliation bill, which might include, the rest of Biden's priorities that haven't been included in this deal.
So the timeline is really important because it really comes down to, this is what could still make or break the bipartisan package. So you have two factions, right? You have the Republican Party, who does not want tax increases, who does not want social infrastructure. And then you have progressive Democrats, and this includes, Nancy Pelosi, Chuck Schumer, the leadership of the Democratic Party in Congress, who basically say, we're not going to pass the bipartisan package unless we also have a shot at our reconciliation bill at the same time. So this creates a problem, right? Because the Democrats don't want to act unless on the Republican plan, unless they get their own reconciliation bill. But then on the other side, you have Republicans like Mitch McConnell, and Jerry Moran is one of the members of this bipartisan negotiating group, who say, if you guys are just going to pass all the stuff we negotiated out in a reconciliation bill, then you can forget having our support on this bipartisan package. What's the point of bipartisanship if you're just going to go your own way anyway? It's stunning to me that they would allow that Republicans would work hard to negotiate out tax increases and simply just, lay down and let them get passed in a reconciliation bill, and then also allow their own bipartisan package to get done. And so sequencing really does matter. I think it's almost certainly easier to get the bipartisan plan done. I think if we're thinking about where the president stands on this, he's going to be the most important player, because if he favors the Pelosi-Schumer angle, that could collapse the entire bipartisan deal. If he seems to favor the bipartisan side, which comments over the past weekend suggest that he does, then maybe he'd be more willing to take up the bipartisan deal first, the $579 billion, the smaller plan. So if they can get that deal done first and basically say, hey, we're not going to do the reconciliation bill, sort of convince Republicans they aren't going to do it, but then turn around and do the reconciliation bill, I think what's more likely is you get the bipartisan bill acted on first. In terms of timing, if you have to do both at the same time, feels like late July before the August recess feels a bit aggressive for that. We're talking about just the bipartisan deal, just the negotiated package. That feels like it's more likely to be a July story, with the reconciliation bill pushing after the August recess until September, really at the earliest. And so the sequencing really does matter. The Democrats want both bills done at the same time. That means they might try and rush both bills into this month. I think if they go that path, it's more likely it drifts later, just because the partisan bill is so large. I think if they go the first bill, the bipartisan bill first, that feels like it could get done before the August recess. So that really feels like a July story.
Okay, so if we're thinking about potentially that coming in July, and I know it's not huge, but it's still 580 billion or 579, which particularly from someone who's looked at the European Recovery Fund, and we just have 750 billion, having an additional 580 feels like a lot, and that could come before the kind of crucial September Fed meeting. Does this change anything for the Fed? Do you think this is kind of feeding into their discussions and their narrative at all, or is it almost too small at this point that it wouldn't really shift the needle for them?
Well, I think it certainly will impact the Fed, perhaps more over the medium term than over the intermediate term. Because when we think about what this bill is, as you mentioned, it is substantial. But when you compare it to the COVID-19 recovery bill from earlier this year, the relief package, it's quite small, and it's also very spread out. So 580 billion of new spending over 5 years amounts to about 115 billion per year. Compare that to the bill just passed from earlier in the year, when roughly over $1 trillion was allocated and spent in the first year. So clearly a more longer term and smaller package. And our assumption is that even if the bill gets passed in July, that money's not going to begin to be spent really until 2022. So in terms of immediate term impact, is this something that's going to really be a game changer as we think about the next month or two? Probably not. That being said, we have a Fed right now that is increasingly confident, growing more confident in the recovery, and having a deal of any kind on the infrastructure front is probably only going to increase that confidence going forward. So does that change the timing of the taper conversation? Maybe not, especially not if a single dime is going to be spent during the run up to that conversation. But if you think about the Fed's tightening cycle, how they feel about the pace of rundown of taper, those things are almost certainly going to be influenced by the possibility of additional fiscal support. And, as we think about fiscal and monetary, you always have those two sides of the coin. If monetary is doing more, fiscal has to do less, and vice versa. Really, the vice versa matters here. If the fiscal is doing more of the heavy lifting, monetary can step back a little bit from the ultra aggressive pace that they've been. And so it certainly does matter. Will it make a big difference for, say, the July FOMC? From a confidence perspective, it certainly will have an impact. Fed probably sounds a bit more confident, but maybe not from a delivered growth perspective. We know they care about the jobs numbers and the inflation numbers. We know they're a data-driven Fed. And so this isn't going to affect one or two, the next coming months of employment data, which will certainly be important.
Okay, that makes sense. Thanks, Brian. So over to you then, Theo, because I think they've been quite, relatively bigger picture conversations, I guess, in Europe and the US today. But actually on the UK side, I guess given that we've already discussed the kind of COVID themes, the second important themes are the technical flows that are coming up. You know, we're at the end of June now, or today when we're recording this. I'm sure when it released, it will be the beginning of July. And so we're starting to look ahead at what these events are coming up in July, which could be quite important from a technical perspective in the UK. So first of all, it's an important month for coupons. So can you just tell us about what's going on there and what's going to happen?
Yeah, absolutely. So first of all, what we find in the UK market is that really investors focus on one theme at a time. And COVID was more of a theme early in the year. Right now in the UK investors to a large extent do believe that there is a breakup between hospitalizations and cases of COVID. So COVID does not matter so much. Last week it was all about the BOE. Right now the market starts to think really about flows. So what is coming, what is lying ahead of us? So coupons, the point that you've mentioned, is going to be crucial because we expect around 2.3 billion of coupons to be paid on the 22nd of July. So these bonds go ex-div around the 13th, 14th of July. And the important part is not just the outright number. The important part is that these coupons come from really back-end gilts. So to the extent that those coupons are reinvested back into gilts, we talk about 4.5 million a basis point of a coupon effect, which is the biggest that you have during the financial year. So it is particularly it can be particularly market moving during a time of the year when in general there is a tranquility. So any additional flow can matter.
Okay, and then the second thing I wanted to ask was that I understand from reading your pieces that it's going to be a big month for index extensions. Is that going to matter at all?
Yeah, absolutely. I think index extensions are what can make this particularly exciting. So it's Giles considers July to be a boring month. Maybe it is a less exciting month in the euro area, but for us, it's going to be very, very exciting. Why that? Well, we looked at three different indices. We looked at sub 5-year gilt indices, then at 5-year plus gilt indices, and at 1-year plus gilt indices. And all those indices, all the three, they will experience an index extension. So first, it is a specific 5-year bond that falls out of the 5-year plus bucket. So basically, the average ended up having longer dated bonds, hence the extension. Second, it's a sub 5-year that ends up with a fairly long bond. So from the 5.1, it falls and becomes a, say, 4.9-year bond. So that pulls the average of the index longer, and the 1-year index as well extends. So to give you an idea and to provide some numbers, we do expect the 1-year plus index to increase by around 0.19. We do expect the 5-year plus index to extend by 0.39. So we talk about significant numbers. Usually it's in the 0.0 something. And we do expect the sub 5-year index to extend by 0.13 years. So that means that additional gilt buying is going to come, right? And that's quite key. This is the pertinent part. And these index extensions, if we assume that around 30% of the market is roughly passive, can lead to around 9 million a basis point of support for gilt. So this is really a theme that we should have on the back of our head, because it is likely to happen in July, and we don't want to be in a similar position like in March when most of the market just missed the index extension. So, and hence we had quite a sizable index move in March.
An exciting July in the UK then. So the other thing I wanted to ask is that in last week's episode, we talked about one of the big events in the UK in July being the syndication. So do these index extensions have any implications for the syndication, or do you have any kind of updated thoughts around that given what we spoke about last week?
Yeah, and this is actually quite a good question. So what I think is that you have a market where there will be a clear need for duration, and that's going to be around 9 million basis point, as said. Now, interestingly, the average maturity of the coupon payments coincides with the duration of the bond being issued. On top of that, if we have a 6.5 to 7 billion syndication, this will be enough to balance out any need for index tracking and coupon flows. Long story short, we think that this syndication will have to be a fairly big syndication, and we think that 6.5 to 7 billion at least. It could be even bigger. It will be quite an important liquidity event given what we've been discussing with coupon money and index extension. Yeah, the potential is even for more issuance to come in. That part of the curve is cheap, and closer to the event, we will look at potentially buying the sector relative to something else. So we need to be on top of our toes. But there is definitely going to be technical buying, and this is why the story of just purely because of supply to assume that yields will go up is flawed, because there is going to be some technical buying, and if you do get also some more fundamental buying, then I think that this could potentially pose some headwinds. At the same time, create a very exciting environment for investors in the UK during July.
I didn't realize index extensions and coupon flows could be so exciting, but you've inspired me, Theo, and I'm looking forward to an exciting July. Giles told me it was all going to be quiet, but I'm just going to look at the UK in July. All right, everyone. Thank you for joining me, and just a reminder to our listeners that if you liked today's episode, please hit the like button to show your appreciation, and click subscribe so you can listen to our latest episodes as soon as they're available. And just a reminder, if you'd like to pose a question to any of our market specialists that we have on the podcast, please send us an email at bondcast@natwest.com. Thanks, catch up next week.